you want to do your due diligence on that individual and that company. But it's less about making sure, like looking at their experience level and how many deals they've done, and more about how you actually feel about them as a person and how you feel about their actual niche. So obviously, in order to determine how you feel about them, you're going to want to make sure you set up an interview with them on the phone. Remembering that it's actually a two-way street, so you're interviewing them and they're technically also interviewing you. At the same time, you want to do all of your research online, your typical research online, and determine, okay, so if they're investing in mobile homes, am I comfortable with that niche? Are they investing in multifamily? Am I comfortable with that niche? Retail, office, whatever. Is it something that you're actually comfortable with? Because at the end of the day, he was saying how no matter what niche you invest in, no matter who you invest with, that first deal is going to be a leap of faith. You're going to have lots of doubts just because it's your first time giving someone else $50,000 to $100,000. And so don't let that stop you from doing it. Just make sure that you're comfortable with the actual individual and you're comfortable with the actual niche that they're investing in. And then one more thing that he said before I toss it over to Jason is, you obviously, after your phone interview, you're going to want to get a list of people who are investing in their deals currently, and then actually, in a sense, interview those people as well, and talk freely with them, and just kind of determine how the deals actually performed compared to how they were projected, and then compared to how the syndicator said their deals performed during that initial conversation. So I know it's a lot there, Jason. So you kind of just pick it apart. Any thoughts on that?
Yeah, so there was actually so much good stuff said there, right? And even one of the last parts is following up with people who have invested in their deals prior. Just because, a lot of people can put together a deal that looks great on paper, but actually when they get into the deal, it's really about the things that are going to come up, because when you have an apartment building where there's 100 or 200 people living in it, and how do they react when they have to make a decision on there, and how are they following back with those investors? Are investors in tune to what's happening on the deal? Another point you really mentioned on that's key is that, it's just, if that person hasn't done this deal before or hasn't done a multifamily deal, what's their track record in life and in business before that? What else have they been doing? What else have they been making of themselves? And honestly, you may be a passive investor in this deal, but ultimately you're partnering with this person from 3 to 5 to 7 years. So if you don't really agree with their views or agree with their take on investments, just having a good deal may not be enough for you to invest with them. Because you're going to be partnered with this person for that amount of time, and their reaction now is not going to change it. They're still going to have a reaction that may not suit you over the time. So take your time to really dive into the person first, and then the deal second, because it's going to be the person that you're going to build with over the years.
Yeah, I didn't ask this question to X-Ray, but I did have a conversation with a passive investor and a syndicator. I think it was 2 weeks ago, and I was asking him how he would like, what would someone need to do if they'd never done a deal before to essentially convince him to invest in the deal. And you actually hit on that when you said that he want to see someone that has experience in business. So did they start have they started a business before in the past? Something, it doesn't have to be anywhere near closely related to real estate. I wish I could remember what business he had started, but it had nothing to do with real estate. But because the act of starting a business, the act of growing something from nothing and dealing with all the obvious hurdles that come along the way, you can take the skills that you've learned and then apply that to raising capital and doing a deal. So obviously I didn't ask X-Ray, but kind of for people who haven't done a deal before, and obviously every single person who's done a deal before has been someone who hasn't done a deal before. And one of the best ways to get over that objection from a passive investor of, well, I want to wait until you do one deal first to see how it goes, because why would I invest with you? It's ideal that you have some sort of track record in some other industry that you can rely upon. And it could even be something like you got promoted every year for 10 years at a company and you're a director or whatever. It's kind of just all about how you position it to the investor. At the end of the day, they just want to trust you with their money. At the end of the day, they have to trust you with their money. And if you graduated college and didn't work for 5 years, then all of a sudden you wanted to raise capital. Well, you're gonna have a little trouble doing that. Whereas if you didn't do anything real estate related at all, or maybe did a few deals on the side, but you worked for a big Fortune 500 company and climbed the ladder there, or if you started your own small business that was successful, aka it generated a profit, then you can leverage that to again essentially convince people to trust you and invest with you.
Yeah, absolutely. Right. And when you think about it, you're spot on, is that we all start and without having done a deal before. And it just comes down to what we've built up in the rest of our parts of life. I was just having a talk with someone the other day. They're like, successful in opening restaurants, but he wants to start now raising capital to help others really achieve financial freedom through investing in apartment buildings. He's like, well, I just don't think people will take me seriously. I'm like, well, why not? He's like, well, I haven't done this before. And well, yeah, everybody's going to start at that point. But you've opened 3 successful businesses. You have employees there? Yes, I do. Well, are the employees now being paid, doing their job successfully because of what you put together? Are they now feeding their families for what you've put together? So think about that track record and use that to your advantage. You've done that successfully. You've built your team. You've built your processes through that, and allow that to transfer over to this business.
Yeah, building a team is also a big one too, because obviously in syndications, a lot of the success, obviously, 100% of the success is dependent on the syndicator themselves, but they have to select the right team because the team is going to be managing the deal from a day-to-day operations perspective.
Mm-hmm.
So, if you've started a business before, you've got actual employees, that's huge. Obviously, if it was successful and it was profitable, that's also huge as well. One more note on this one before I move to the second point I wanted to talk about, which is he did mention that a big red flag that he would see. So he talked about what he wants to see. Here's the things that he does not want to see. And the one red flag that he mentioned was unrealistically high or inflated returns. Again, so he's kind of implying that the person who's a passive investor has experience analyzing deals. He mentioned that he analyzed a ton of deals from a ton of different sponsors, and so that's one thing that you should do as a passive investor is analyze a lot of deals, because then you can recognize, okay, I've looked at 100 deals, 99 of those deals had between an 8 and 10% return, but this guy's telling me he can get a 15% cash on cash return with a very similar deal. I know something is most likely going on here. Or if you're kind of even better at crunching the numbers and able to analyze not the actual cash flow calculator, because they're not going to send you that, but just looking at their pro forma, and you can see, wait a minute, like this expense seems like it's really low, or I think they're missing this expense, or wow, they're going to raise rents by this much money by only investing $1,000 per unit. So something that just looks unrealistic, but really the only way to know what's realistic and what's not realistic is to analyze a bunch of investment summaries and go on a bunch of those new investment conference calls or webinars.
Yeah, and this is a great point for people that want to be active and want to be the syndicator themselves and raising money and buying deals, because ultimately, you say, well, I can't find a good deal. Well, you should be analyzing as many bad deals as possible, because as soon as a good deal comes across your table, you're going to know it so quickly because you've already gone through all the fat and all the bad deals that are out there on sites and are just being pushed around from person to person.
Yeah, exactly. So this X-ray guy and then other passive investors that I've interviewed, they're on all the email lists. So whenever a syndicator gets a new deal, it gets sent to them. They'll go on the conference call. It only takes a few hours a week. If you look at one deal a week, it's maybe a few hours on a conference call, and then maybe another hour reviewing the deal. So spending 5 hours, maybe an hour a night. Again, over time, you'll learn what's good and what's bad. And not even that, you'll be able to identify what's good and what's bad. And then once that, as Jason mentioned, once that good deal comes, to be able to see that.